Hello, everyone, and welcome to Economic Impact. Today is January 9th, and I want to take the opportunity to give our best wishes to friends and family of National Bank of Canada. Hello, Stéfane.
Happy New Year, Martin.
Same to you. Stéfane, a couple of weeks ago, we talked about 2022, and it's important to look at it with the final numbers. And it was the worst year ever for a balanced portfolio.
Yeah, Martin, I can make an easy claim. No one alive has ever seen a bad year like we saw in 2022 with the combination of stock market being down 22% and the bond market being down roughly 15%. You can see on this chart that it had never been observed on this magnitude. And Martin, what was stellar also for 2020, or very telling for 2022, is that it was the first time since 1958, 1959 that the bond market had two consecutive years of drawdown. So not a good year for fixed income holders in both 2021 and 2022.
And Stéfane, if I look quickly at all the dots, the bond market has never been down 3 years in a row.
No, Martin, and I don't think it will be, and that's important. And the reason I don't think it will be is because we're looking at a slowdown in 2023. It's actually the most anticipated recession of all times. Never before have we seen such a large portion of professional forecasters calling for a contraction of the U.S. economy this year.
And Stéfane, despite all of the gloom and doom that we read in the media over the holiday season, yet the markets are up strong to start the year.
Yeah, so it's a large proportion of forecasters are calling a recession, Martin, but it's around 50% as we stand right now. So it's not surprising if you call a recession that the bond market would do well, start the year relatively firmer. But what's surprising, Martin, it's been outpaced by riskier assets, so stock market up everywhere around the world, emerging markets, commodity producers, the tech sector, every sector is up this year. And that is quite surprising. It's a really great start to the year.
And Stéfane, to explain that, we can look at fresh news on the inflation and specifically on supply chains.
Yeah, I think the expectation we were trading on inflation all through 2022. I think it's still a story for 2023. And what the market is seeing right now, if you look at the manufacturing sector, supply delivery times, input prices, new orders are all coming down, suggesting a very rapid decline in inflation for goods. Martin, we had already started to see this. It's just being confirmed even more, and I think that's really important from an inflation perspective.
And you just said we had already seen this, but not on the service side, which was a real surprise.
Yeah, well, that's the big thing as we start 2023. The central banks have been saying that it will take probably almost a full year for inflation to come down in the service sector. But what we saw in the latest data, no later than December of 2022, we saw a big drop in economic activity in the service sector, which is 65% of the economy. And the drop in December was the second largest in over a generation. So, Martin, that does suggest less economic activity in services. And as you know, inflation is a lagging indicator on activity. If activity comes down, then inflation is likely to come down also in the coming months. So I think that was a key development to encourage markets that inflation would come down probably faster this year.
And Stéfane, everybody talks about the recession, but the key is the labor market.
Well, there's the thing, Martin. You don't want to overdo it. If economic activity comes down too quickly and then you start to impact the jobs market, then purchasing power is eroded, there's deleveraging, and not a pleasant outcome for financial markets, particularly for equity markets. So what we're seeing, Martin, at this time is that the possibility of a soft landing is still there. Yes, total employment was up at the end of last year in the US, but we're seeing that full-time jobs are stalling right now for a few months. So that does suggest that corporations are being careful, hiring full-time, which means less wage inflation, which also suggests that the possibility of a soft landing is still there, Martin. I think it's a 50-50% call.
And that's really interesting, Stéfane, because at the moment, this tug of war going on, we're seeing the markets essentially not believing the Fed.
Yeah, in order to achieve a soft landing, Martin, however, it's important that the Fed stops raising rates. And what we're seeing in recent weeks is that the 2-year Treasury yield is actually below the Fed funds rate. Now, historically, the Fed has never raised the policy rate when the 2-year Treasury yield was below the Fed funds. So I think that we're getting near the point where the Fed can stop raising rates. The market has already jumped gun on that one and saying the Fed is done, maybe 25 basis points. And that's a lot less aggressive than what the Fed continues to send out in terms of indication guidance to markets right now. So the bond market no longer believes the Fed that they have to hike aggressively this year.
And one of the main themes of 2022 was the strength of the U.S. dollar, and that is starting to erode, Stéfane.
Well, if you stop the Fed, Martin, you stop the surge in the U.S. dollar, which was the story for 2022, as you say. So what we've seen in recent weeks is U.S. dollars starting to come down. That's good news for emerging markets that have a lot of debt that is denominated in U.S. dollars. It makes easier, debt servicing is easier. And also for commodity producers such as Canada, as the U.S. dollar comes down, then it's less downward pressure on commodity prices. So I think it's a win-win situation for the global economy if the U.S. dollar weakens. And I think part of that, Martin, reflects the fact that there will be some divergence in monetary policy this year and that a potential offset to U.S. dollar or the U.S. economic weakness is the fact that the Chinese economy is reopening. And I think that's the biggest surprise of recent weeks, this announcement by Chinese authorities that lockdowns are behind us and that they're reopening to the world, which will also help bring down inflation, I think.
Stéfane, in conclusion, we are seeing a slowdown in 2023. There's this tug of war between those who claim there's going to be a recession and a strong labor market. There are a lot of elements compensating for the fear of a slowdown out there. And what is your take?
It's a really a tough scenario, Martin. So I think it's still the 50-50% chance of soft landing versus recession. I need to confirm the inflation numbers in the coming months. I think things are going in the right direction, but we need to confirm also that the central banks will pivot in the coming weeks. So I would argue that the same conclusion that we gave a few weeks ago to our clients still stands. Let's be careful as we start the year. Yes, it's been a great start for equity markets, but let's confirm that these inflation data starts to come down and the central banks are done hiking, and that gives us a greater chance of achieving a soft landing, which would be more constructive for markets.
Excellent. Thank you very much, Stéfane. And once again, Happy New Year, everybody. Thank you.